We are back. Our guest is Rebecca Teltscher, portfolio manager at Newhaven Asset Management. Thanks so much for sticking with us for a second block.
No problem.
And the TSX, are you more attracted by the TSX or US stocks right now?
We've always been more attracted to the TSX for many reasons. I mean, one, the multiple difference between what the TSX trades at versus the S&P 500. I mean, that has widened. I think valuations are twice as expensive on average on the S&P 500. You know, the S&P 500, you think about it as a basket of 500 stocks, so you're getting a diversified basket portfolio. It's really not, because it's market weighted. And so the Magnificent Seven, which is predominantly technology stocks, really makes up, you know, a large chunk, whether depending on what the market value is, but around 30% or so. So you're not really getting that much of a diversification.
There's hidden risk there.
Absolutely. So, you know, when, you know, a third to a half of the S&P 500 is really banking on, you know, one growth theme, which is, you know, AI, you know, that there's an inherent risk there, and the multiple, you know, is really expensive. So that's one reason. The other reason is, you know, we focus really on long-term stable companies. We like dividend income, and, you know, the TSX has, or at least Canadian stocks, not necessarily the TSX, but the companies that we own that are predominantly in Canada, pay a dividend, and that dividend generally increases over time. In the US, there's less of a focus on dividend income, more of a focus on share buybacks. And I think I attribute that to the US market being more short-term in nature. You see a price target, and whether, you know, a stock can reach that price target in 6 months to a year, like that's, you know, analysts basically look at a name on a 6 month to 1 year basis. And share buybacks are a good way to increase the value of a share on a short-term basis. But management essentially can turn on or turn off a share buyback, you know, with the flick of a switch. A commitment to a dividend is a long-term commitment. You are committing to giving back shareholders in the form of a dividend or income consistently over time. If you cut that dividend, obviously it's a betrayal, or you're breaking that long-term commitment to shareholders.
It's very visible.
Absolutely. So, you know, in Canada, I think there's a lot more stocks that you can find that have a 4 to 6% dividend yield that are still increasing and growing, and those dividends are essentially backed by cash flows that are increasing over time. So we've always liked the Canadian market better than the US market with regards to valuations and dividends. Obviously, since, you know, tariffs have been introduced and the trade uncertainty, it's just, we haven't shifted our thesis. We're still in Canada, but there's even more of a reason to be invested in Canadian stocks and Canadian companies right now. Part of it, obviously, is the patriotism, but also what we've seen since, you know, Liberation Day on April 2nd, we've seen a lot more volatility on the US side than on the Canadian side. And I think that's just because assets have been really overvalued in the US. So when you see more volatility, some of that steam is coming out, or the bubble is being deflated on the US side. I mean, we've seen it a little bit in Canada, but, you know, we've seen larger moves in the NASDAQ where valuations have been higher.
And it really, to your point there about the tech domination of the US markets, you can see 2021, 2022, the US market slid with those big tech stocks dropping.
Absolutely. So we saw it in 2022. We saw, you know, that the tech companies, like, valuations kind of come back to reality. And then what happened in 2023, there was the AI boom. I think it was, you know, ChatGPT came out at the end of 2021. So, sorry, at the end of 2022. So 2023, 2024 was really that AI boom, that AI, you know, that growth, and everyone just, you know, even though there wasn't that much growth in the overall economy, you just saw the shift from assets to, you know, safer names into these, you know, tech names that kind of created a bubble. And we're seeing that, you know, bubble deflate for, you know, in 2025, minus the past month. I mean, in the past month, we've really seen a reversal of a lot of those losses that we don't believe is that we don't think is sustainable right now.
What about the Canadian banks? They start reporting on May 28th, and John Aiken of Jefferies says there could be front-loading of provisions. The banks, understandably, don't really know where the economy is going to go, and he thinks they could be cautious, book a whole bunch of potential provisions for bad losses.
Yeah, I'm nervous about the banks right now on a short-term basis. I think on a long-term basis, it's okay. I don't think the banks are really factoring in, as much recession risk or tariff risk as they may need to adjust, as you said, taking more provisions. So I think that could be a negative earnings surprise when they start reporting. But at the end of the day, I believe Canada's probably already in a recession. We kind of saw that negative GDP last month. I mean, who knows what's going to happen this month? Who knows what's going to happen with tariffs? But we're kind of seeing, at the end of the day, any kind of uncertainty that just trickles down. I mean, it creates less business investment, less hiring demand, and less consumer confidence. When you have all those things hitting at the same time, that's going to negatively impact GDP. Obviously, banks are pretty, are pretty correlated to GDP, so we could see some negative quarters in the banks. I mean, the banks are well capitalized, so they will do okay in the longer term. So I do think if we see some weakness, that could be a buying opportunity. We're not really buying them now. We're kind of waiting to see what happens, as you mentioned, if there's going to be some provisions, if there's going to be some short-term weakness that could create a better entry point for us.
Although John Aiken of Jefferies says, as you say, the balance sheets are strong and he expects dividend growth to continue.
Yeah, exactly. So again, on a long-term basis, as we talk about, dividends are not a short-term commitment to shareholders. It's a long-term commitment. So even if there is a recession in the short term, that doesn't negate the long-term commitment to paying back shareholders in the form of dividends on the long term.
Rebecca, thank you so much.
Thank you so much.
The week off.